Good evening, students. Welcome to the session. So today what we are going to start with is PGBP. I hope if you have any questions surrounding the earlier class, you can ask. But we'll quickly start with PGBP now. We have already completed residency and the basic concepts in the last class. Now this is very, very interesting chapter. So let's just quickly start with it. Profit and gains from business or profession. Yes. So this you would have also done as a part of your IPCC, but this is going to be very in depth, and this is the heart of your entire direct tax. So first section, just before we even proceed to PGBP, let's try and understand one very important thing. So remember, in the first class, in the basic concepts, we were under section 4. We were discussing about section 4. What did I discuss with you under section 4? About the total income. So total income is defined where? Under section 245, which refers to the income computed as per the provisions of the Act. Are we clear? So now, how do we compute the income? Before we get into PGBP, I'll just talk about that. How do we compute the income? What is the means of computing the income? So that's what we are going to learn. So now if you see, every head of income has the computation provisions for that particular head, for that particular category of the income, right? So let's say salaries, we have a separate charging section for that, and then we also have the computation provisions which are applicable for the salaries. Are we clear? So section 14 of the Income Tax Act provides for the computation of the total income. Section 14 of the Income Tax Act. Are we clear? So we have 5 heads of income: salaries, house property, PGBP, CG, income from other sources. And all of these heads have their own charging section and separate computation mechanism. For example, under the head house property, we have standard deduction of 30%. Whereas if you have business income, then you get almost entire allowance for a particular expenditure subject to certain disallowances. Are we clear? Under the capital gains, most probably we have only the cost of acquisition and the cost of improvement, which is allowed as the deduction. So for every head of income, we have separate computation provision. Charging section for salaries is section 15. For IFHP, it is 22. Then for PGBP, we have 28. For capital gain, we have 45. And from income from other sources, we have section 56. Right? Now, under these charging sections also, we have general charge and specific charge. We have general charging section and then we have these specific charging sections. Now, understand one thing. So, when I'm talking about the general charging section, right? When I'm talking about the general charging section, it is the basic charging section which is there, which is what we are going to see also. There are specific charging sections as well. And under the specific charge, whatever is specifically put under there that is chargeable under that particular head of income only. For example, dividend. For example, dividend is specifically chargeable under section 56. So dividend is specifically chargeable under section 56. So that is the specific charge. So means certain amounts are specifically covered under particular head. So even if the investor would be trading or dealing in shares, it would still be taxable under income from other sources. Right? Whereas there are general charging section which deals generally with the particular head of income. Are we clear? So now we are going to introduce you to PGBP. Now under the PGBP, again, section 28 of the Income Tax Act, as I said, is the charging section. Section 28 of the Income Tax Act is the charging section for PGBP. Now, before that, I would take up certain case laws with you, wherein I require you to answer me whether you think that this particular category of income is chargeable under the head PGBP or is chargeable under any other head of income. Now, these are very, very important decisions. Are we clear? The first decision is in the context of Chennai properties. The first decision is in the context of the Chennai properties. Now, in that particular case, what had happened was that the particular company, Chennai Properties, was in the business of, or rather was dealing in the leasing of the immobile property. So Chennai Properties was dealing in the business of the immobile property. Now, the company's memorandum of association had the object clause. So the object clause of the company clearly mentioned that the main objective of the company was to acquire and let out the properties. And the entire income of the company was also from the letting out of such properties. So the taxpayer offered the income under the head PGBP. Whereas the tax officer, the AO, contended that this should be chargeable under the head income from house property. So section 22 of the Income Tax Act, which deals with the income from house property, which provides that the annual value of the property consisting of any buildings or lands appertaining thereto of which the assessee is the owner, other than such portions of the property as he may occupy for the purposes of any business or profession carried on by him, shall be chargeable to income tax under the head house property. Now, what do you think in this scenario, whether it should be the rental income should be chargeable under the head IFHP or under the head PGBP? What do you think? PGBP, okay. Yes. So the Supreme Court also, this is a Supreme Court decision, you can write it down. So first we are dealing with the classification of the income. So Supreme Court in Chennai Property and Investment Limited, it observed that the object of the company needs to be looked. So object of company needs to be looked into. So the Supreme Court said that it observed that the deciding factor as to under which head the income was to be charged is not the ownership of the land, but the nature of the activity of the taxpayer and the nature of the operations in relation to them. So the object of the company must be looked into with a view to interpret the activity. And the main objective of the company as per its memorandum of association is to acquire and hold the properties and earn the income therefrom. And therefore, the Supreme Court in that case held that the rental income from the properties shall be taxable or chargeable under the head PGBP. So, rental income chargeable under the head PGBP if the main object of the company is to let out the property. Are we clear? So it shall be chargeable under the head PGBP and not under the head income from house property. Now, there was a similar decision in the context of Raila Corporation Private Limited. Same decision again of Supreme Court. So you can also note down Raila Corporation Private Limited Supreme Court, wherein also the Supreme Court had referred to its decision in the case of Chennai property and equally applied the same to the Raila Corporation Limited. There was a contrary decision of the Supreme Court in the context of Rajarkar and Associates. Now, in this particular case, what was held was, or what were the facts? Before we even come to what was held, what were the facts of this case? So, in this case, the assessee had acquired the right to conduct a market on certain land. So, he had bought the land and then he had, on that particular structure, built the shops for the purpose of leasing it out or built the stalls. And he had offered that income as the business income. Again, this is a Supreme Court ruling. But the tax officer or the AO said that no, it should be chargeable under the head house property. So for this particular decision, the Supreme Court looked into the facts of this particular case and the object clause in the partnership deed. So this was a partnership and not a company. So then here they looked into the partnership deed. So the Supreme Court, by looking into the partnership deed, noted that the assessee's object clause of the partnership deed provided that the letting out and earning the rent is the main income, is the main business activity. So letting out and earning the rental income therefrom is the main business activity. So the partnership clause had clearly provided that the partnership shall take the premises on rent to sublet. However, it held that this clause is inconclusive because the assessee has failed to prove that its entire or substantial income was from letting out of the property. So in this case, the assessee failed to prove that the renting out was the major income or the substantial income of the assessee. Whereas in Raila and Chennai properties, the rental income was the substantial or the only income of the assessee. So if the substantial income is from letting out of the property and the letting out is the main objective of the company, the income would be taxable under the head PGBP. So in this case, they distinguished the Chennai properties and Raila decision and held that the income is to be assessed under the head income from house property. So here they held that rental income is to be assessed as income from house property and not as business income on account of lack of substantial material to prove that the substantial income of the assessee was from letting out of the property. So in exam, how you're supposed to write then? See, if the facts suggest that it cannot be clearly proved that the substantial activity is the letting out or the substantial income is from the letting out of the property, then in that case, you will have to follow the Rajarkar. But if the only activity is letting out, or if the main activity or the substantial activity, substantial income is from the letting out, then you can follow Chennai property ruling. Are we clear? Any doubt? Okay. Another question, which was in the context of Tamil Nadu Tourism Development Corporation Limited. This is the another case. In this particular case, the assessee company was engaged in the business of tourism development. Now, as a part of it, it leased out certain loss-making hotel units to various franchisees. Now, the franchisees had entered into the agreement with the assessee for leasing of hotel. Then the agreement had certain terms and conditions to be complied with as to how the franchisees should conduct the business, which also had one of the condition was that the assessee's name should also be included above the name of the franchisee in the name. Now the assessee had offered this income under the head income from house property and had claimed 30% of standard deduction. Whereas the AO claimed that or contended that the income should be taxable or chargeable under the head PGBP. So the question before the High Court was whether the franchisee fee received by the assessee was business income or was to be chargeable under the head IFHP. What do you think here? Whether the AO was correct? or the assessee was correct? PGBP or house property? Also, please give the reasons, whatever you think. A was correct or assessee was correct? Please give your reasoning. The AO's contention was that he was carrying out the business based on the agreement. Tanuku, I didn't understand your point. PGBB as its name to be mentioned seems like a HO. What do you mean by HO? Okay, let's try and understand. What did the High Court say in this particular case? So the High Court looked into the contract, and the contract had certain terms and conditions attached. Right? The contract had certain terms and conditions attached. Now, the terms and conditions were in the nature of that the business by the franchisees had to be carried out in a specified manner. Also, if you see that the assessee had put the condition that the assessee's name should always be mentioned on the name board, isn't it? So all these conditions depict or illustrate that the assessee was carrying out the business of the tourism. So this was not for the incidental letting out, but this was with the objective of promoting his tourism business. And therefore, the High Court held that this franchisee income should be chargeable under the head PGBP and not under the head under the head IFHP. So this was the case where the High Court held that the assessee had leased out its business asset and gave a special right to the franchisees to undertake a particular business in the property of the assessee on the receipt of franchisee fee. Income was in the nature of the business income. This was a Madras High Court ruling. So, franchisee fees was chargeable under the head PGBP and not IFHP. And not IFHP as the assessee had not merely leased out business assets, but had leased with further conditions. As to how the business of franchisees should be conducted with regard to hotel industry. Which makes it clear that the assessee continues to be in the business of tourism activity. Though not directly, but through the franchisee. Are we clear? So therefore, this was held to be the business income. Any doubt? Any questions? Any doubt? Yes. The nature of income is important. The nature of activities along with the nature of the income. So see, you see the Rajarkar case, there also the assessee was carrying out the sub-licensing, right? So in the Rajarkar case, the assessee had constructed various shops and stalls and had sub-licensed that. So therefore, in that case, still, if you see, it was held to be taxable under the head income from house property because the assessee had not established that it was engaged in any systematic or organized activity of providing service to occupiers of shops or stalls. And we have mentioned under the object clause that the business of the assessee was to take premises on rent and to sublet the same was not held sufficient to conclude that the income was taxable as the business income. Are we clear? So, you have to conclusively prove that you're carrying out a particular activity. Are we clear? Any questions? So, there could be instances where a particular income may appear to fall in more than one head. It could fall under IFHV, it could fall under PGBP, it could fall under income from other sources. So, income has to be treated under any of the one head, right? So, tests which are to be applied for determining the real nature of income are based on the judicial decisions, are based on the interpretation of the provisions of these particular heads. Are we clear? Any questions? Okay. Now going further, one more important decision which I would like to cover with you is in the context of Gujarat State Fertilizers and Chemical Limited. Now, what was this decision regarding? So in this particular decision, this was by the High Court, again a High Court decision, Gujarat State Fertilizers and Chemicals Limited. Gujarat State Fertilizers and Chemicals Limited. Now here the assessee was engaged in manufacturing of fertilizer as the name suggests. Now the sale price of the fertilizers is fixed by the government And many times the price is lower than the cost of the production. So therefore, to compensate that, the manufacturer is sometimes given the subsidy by the government. Now, due to cash crunch, sometimes instead of granting the subsidy, the government gives the bonds, the fertilizer bonds. Now, these bonds can then be sold in the open market and the price of the bonds will vary. Now, in this particular case, the assessee had received these bonds as a matter of subsidy and then it had sold those bonds at a loss, which the assessee treated as a business loss. While the AO argued that this should be chargeable under the head capital gains. So, do you think it should be the capital loss or should it be the loss under the head PGBP? What do you think? Whether PGBP or capital loss? Okay. PGBP, capital loss. Okay. So in this case, if you look into the section 45 and we have to look into section 28. Section 45 is dealing with the capital asset. Now the question is whether you would treat it as subsidy loss or would you treat it as the loss on the sale of the capital asset? So that's the question. Are we clear? So that is one of the very important questions which we are looking here. So here the assessee received these subsidies. And the court said that the subsidy would have been taxable under the head business income. Right? So here where the assessee is now engaged in the manufacture of fertilizers, central government instead of giving cash subsidy issued the fertilizer bonds. So the court held that these bonds were never acquired by the assessee as investment or capital. These bonds were never acquired as investment or capital. So here the bonds were issued in lieu of the subsidy which was due from the government. However, when the bonds were received, the market value was less than their face value. And the assessee claimed the difference as the business loss. So where the bonds were never acquired by the assessee as investment or capital, but those bonds were received instead of the subsidy. So therefore, in that case, the High Court held that this was the part of the subsidy. This bond does not make an investment. This bond is not an investment. So loss on actual sale of bonds cannot be considered as capital loss, but the same was required to be allowed as the business loss. Are we clear? Are we clear? So realization to the sale price by way of subsidy in the form of fertilizer bonds does not make bond an investment. because these bonds were never acquired by SSE as an investment for capital, but the same were received as subsidy. So loss on sale of bonds cannot be considered as the capital loss. Are we clear? So here, loss on sale of bonds received in lieu of subsidy business loss and not capital loss. Any doubt? Okay. Now last one ruling, which is not on classification of income, but it is mainly on that when the income will be taxable or in whose hands. This was in the context of Henkels Pick India Limited, Supreme Court. Now, what was this particular decision about? Now, in this case, the assessee had received the share application money. The assessee came with the IPO and it received the application money. Now, as per the company law, you have to deposit it in a separate bank account. This is a statutory requirement, right? Unless the allotment is made. Now, assessee had refunded the money along with the person, along with the interest to the person who could not be allotted the shares. So, assessee had opened a public issue of shares. It received the application money and shares were allotted in the next financial year. So, it opened a public issue in say in the year 91-92. It received the application money and the shares were allotted in the financial year 92-93. The assessing officer taxed the interest income in the financial year in which the share application money was received. That is in financial year 91-92. The assessee had argued that the interest will accrue only on the allotment of the shares. As before the allotment of the shares, the amount was kept in a trust which belonged to the applicants. So, assessee argued that this amount will be only taxable on allotment of the shares. Are we clear? The question is clear. So, whether interest income earned on the share application money deposited with the bank for a specified period in accordance with the statutory requirement becomes taxable in the year in which the allotment is done or in the year of the accrual of the interest. What do you think? When will it be taxable, in the year 91-92 or in the 92-93? Nanuko, you think accrual of the interest, okay? Aditya, in the year of accrual. Bombay, you also think in the year of accrual, 91-92. Okay. Supreme Court does not think in that way. What the Supreme Court is saying is that the company is earning the interest. However, the amount is not fully available to the company for its own use from the time the interest accrued, as the interest is an amount which is accruing on a fund which is not available with the company. The amount is kept in a separate bank account. So a company will not be able to use that amount until the allotment is completed, and it will have to return the money to those who have not been allotted any shares. So no part of this amount received, either principal or interest which is accrued, can be utilized by the company until the allotment process is completed. And the money is paid to those who have not been allotted any shares. So it is only after the allotment process is completed and all the monies are payable to those who have not been allotted any shares along with the interest, the balance remaining amount of the interest earned on the application money can be said to be belonging to the company. So until the allotment process is finished, the application money along with the interest earned thereon will remain within a trust in the bank. So this particular amount will be taxable in the year 92-93 when the allotment is completed. Are we clear? This is a Supreme Court ruling. You can write it here. The interest on the application money cannot be regarded as an amount available to the assessee for its own use until the allotment of shares get completed. And money are returned to those whom shares are not allotted. So no part of this fund no part of this fund can be utilized by the company until allotment process is completed. Therefore, the interest would be taxable only after or only on after allotment is completed. Are we clear? Any doubt? Any question? Any doubt? Okay. Then another one decision which I would like to cover with you is in the case of K and Company, Delhi High Court. Now, this particular decision is in the context of the interest income on funds kept as margin money. Interest income on funds kept as margin money. So, in this case, what happened was that the assessee was required to offer some bank guarantee. Right? Offer some bank guarantee. So, here it had to keep the funds, right, as margin money. Now, in this case, the assessee had to give this bank guarantee, right? When he had to give this bank guarantee, the interest income which was earned subsequently on the margin money deposited with the bank for obtaining that bank guarantee. Question was whether this is taxable as the business income. So what do you think? Whether this is taxable as business income? Or whether this will be taxable under the head income from other sources. What do you think? Other sources? Why, Tanuku? Why do you think other sources? So section 56 talks about income from other sources, where it also deals with the interest income. So whether year 56 or under 28. What do you think? Income from other sources, okay? So if you look at 56, if you look at section 56 of the Income Tax Act, it talks about the interest income, income by way of interest. If interest on securities, it says if not chargeable to tax under the head PGBP. Right? So interest income, which is there, if it is not chargeable to tax under the head PGBP, only then it can be classified under income from other sources. Now, in this particular case, the assessee had to furnish the bank guarantee or performance guarantee, and for that purpose, it had to deposit certain fund as margin money in a bank. So the interest income which was earned was not earned on the money lying idle with him for running the business. This interest was earned by virtue of terms and conditions to submit a performance guarantee and for which he had to deposit certain funds with the bank. So interest earned will therefore be taxable under the head PGBP and not under the head income from other sources. Are we clear? So therefore, in this case, it was held to be PGBP. Interest on funds kept as margin money for obtaining bank guarantee to carry on the business is PG. Are we clear? Any doubt? Any question, any doubt? Okay, then let me ask you another question. This is an old decision of Supreme Court in the case of Tuticorin Alkali Chemicals and Fertilizers Limited. So in this case, the assessee company, during the construction and establishment of its factory, before even it could commence the manufacturing activities, invested the funds which it had borrowed for the purpose of setting up the factories. So it had borrowed certain funds, and meantime, till the factory construction gets started or the manufacturing activities get started, it invested those borrowed funds in short-term deposits with the banks and earned the interest. So the question is that whether this interest would be taxable under the head income from other sources or under the head PGBP. What do you think? What do you think? PGBP or income from other sources? Okay. So in this case, what the Supreme Court said? That here, first of all, the interest earned on the short-term investment of the funds borrowed during the construction of the factory or before the commencement of the business whether it has to be assessed as income from other sources. So the Supreme Court said that yes. So here the Supreme Court observed that the company had chosen not to keep its surplus capital idle, but had decided to invest it fruitfully. So if the capital of the company is invested, instead of keeping it idle, the income which it will generate, that is specifically chargeable, the interest income is specifically chargeable, is under the head income from other sources. Right? So the interest earned by the assessee is clearly chargeable under the head PGB, under the head income from other sources. So here, this was not the business. This was more of the investment of the idle funds. And therefore, this was held to be the income from other sources. Are we clear? Any doubt? So, interest on surplus funds deposited, income from other sources. Any doubt? Any questions? Any doubt? Okay. So let's proceed then further towards section 28. Now we are going to start with section 28. So I'll put up 28 for you verbatim. So section 28 is the charging. Section 28(1) is the general charge of PGBP. Are we clear? Section 28 is the general charge of PGBP. 28(1) provides that the profits and gains of the the profit and gains of any business or profession which was carried on by the assessee at any time during the previous year. So now we are going to break this section into several segments. Okay. So the first is the profits and gains from. This is your general charge, right? So first is profits and gains from. This is my first. Of any business or profession carried on by the assessee at any time during the previous year. Now we are going to break one by one. What do we understand by the term profits and gains? The term used here is not gross receipts. The term here used is not income, but the profits and gains. So how do you determine the profits and gains? The profits and gains of the business are to be determined on the basis of the commercial accounting principles. You have to determine the real profit as per the commercial accounting principles. Determine as per commercial accounting principles. We also have section 145. What does section 145 provide? We also have section 145, which provides for the method of accounting, which provides that income chargeable under the head PGBP shall be computed in accordance with either cash or mercantile system of accounting regularly employed by the assessee. So, section 145 provides you the method of accounting, which clearly provides that the income has to be computed in accordance with cash or accrual system regularly employed by the assessee. Section 145(2). Section 145(2) empowers the central government to notify income computation and disclosure standards, ICDS. So by virtue of the power under section 145(2), central government has notified ICDS. Central government has notified the ICDS, and we have 10 ICDS. Are we clear? So, profits and gains, how they are to be computed as per the commercial accounting principle, and where we have ICDS as per the income computation and disclosure standards. Are we clear? Any doubt? Any question, any doubt? Okay. So 145 is talking about your method of accounting, and 145(2), central government has notified 10 ICDS. Now, the ICDS are applicable for the computation of income under the head PGBP as well as under the head income from other sources. It is not for the purpose of maintenance of your books of account, but this is for the purpose of computing your income. Are we clear? So we have total 10 ICDS, which we are going to look at it separately. Any questions? So ICDS is not meant for the maintenance of the accounts or for preparing the financial statements. Companies are required to maintain books of accounts and prepare financial statements as per Companies Act 2013. These are only for the purpose of computing the income under the head PGBP. Are we clear? Any doubt? Okay. So then let's proceed further. The second one. Profits and gains from business or profession. What do we understand by the term business or profession? Is the term business or profession defined? So if you look, whether the term business is defined, the answer to that is yes. So section 213 of the Income Tax Act defines business, which includes trade, commerce, or manufacture or adventure in the nature of or concern in the nature of trade, commerce, or manufacture. Right? So business is defined to include any trade, commerce, manufacture, or any adventure or concern in the nature of trade, commerce, or manufacture, which means a systematic and continuous activity which involves skill with the labor with the motive to earn the profit will be considered as business activity. So we already saw what could be considered as a systematic activity. So you saw how in Rajarkar and Associates case, the Supreme Court went on to held that the assessee was not carrying out the systematic activity of doing the business. And therefore, the rental income or the income from subletting was held to be taxable under the head income from house property because the assessee was not carrying out the systematic activity of doing business. While in Raila and Chennai properties, it was clearly held that the assessee's main objective was to do the business of letting out of the properties. And therefore, it was held to be the business income. Are we clear? One more example I can give you. So there was a case of Suresh Chand Goyal, wherein the assessee had a huge plot of land. The assessee had a huge plot of land. Now, it was not being able to dispose of that particular plot. So in order to secure the better price, what assessee did was, it converted into small pieces of plots. So it had like a huge plot which it was not able to sell it independently. So what it did was, it converted those plots into small 40 plots. It developed those plots and then it started selling out those plots. Now, whether this is a systematic activity or the adventure in the nature of the trade, or was it to be taxable under the head capital gain, on the basis that the sale of plots was not a business activity? What do you think? Do you think it should be capital gain or it should be PGBP? Tanuk, you think BGBP? Okay. So what in this case was held was that the assessee was selling out the land by dividing it into plots, was not an adventure in the nature of trade. Why? The reasoning was that this was isolated transaction or activity. An isolated transaction or activity cannot be part of the business. So there must be a regular activity of purchasing and selling. And here, there was nothing to show that the land was purchased for the purpose of selling. So this was done because the Atati was unable to sell it, and therefore it converted a bigger plot of land into smaller pieces. So this would not come within the purview of adventure in the nature of trade. And therefore it was held to be that the income was chargeable under the head capital gains and not the business income. Are we clear? So here it divided the pieces of land into several small pieces because it was unable to sell it. It was not his business, or it was not the systematic activity which he was carrying out. So therefore, the court held that this was to be chargeable under the head capital gains. Are you getting the distinction? Clear? Okay. So business or profession. Now whether the term profession is also defined? Whether the term profession is defined? Yes, it is defined. So section 236 defines the profession to include vocation. Profession includes the vocation. Section 236 defines profession includes the vocation. Are we clear? So that is how the term business and profession is defined. So profession includes vocation. So let's say, for example, any let's say preach is there, right? In that case, if they are receiving any donations from their followers, then in that case, that will be income taxable under the head PGBP because this is in the exercise of the vocation. Are we clear? Then the third one is carried on by the assessee. So carried on by the assessee. What do we mean by carried on by the assessee? So let's say, for an example, if I have hired an agent for the purpose of generating sales, so even the sales carried out by the agent would be included in my income. It is not necessarily that I am myself carrying out the business, right? It is very well sufficient that if an agent is exercising the activity, or if the business is also being carried on by the agent, that is sufficient. So carried on by the agent, because what agent does on behalf of the principal is as good as the principal doing himself. Are we clear? Then at any time during the previous year. Now first, what do we understand by the term at any time? So this includes agent also. Okay, at any time. Now let's say I was carrying on the business or the profession, but suddenly the business or the profession is discontinued. Then in that case, the income which is received by me, say after discontinuance of the business, how would that be taxable? We have already discussed this in the first class also, if you remember. Does anyone remember? If you have revised, you would remember. Discontinued business or profession. Go back to your previous notes. What did we discuss in the first class? Can you see on the slide what it was? Yes, Tanuku, you're correct. In the previous year itself. So exception to the rule that the income chargeable to tax and the income earned in the previous year is chargeable to tax in the next following assessment year. So exception to that rule was discontinued business or profession. So where any business or profession is discontinued, the income of the period from the expiry of the previous year up to the date of discontinuance will be charged in that particular year itself, right? So this 176 section is for the discontinuance of the business and 176(3)(a) is for the business, 176(4) is for the profession. So where any business is discontinued in any year, any sum received after the discontinuance shall be deemed to be the income of the recipient and charged to tax in the year of receipt. Similarly, where any profession is discontinued in any year on account of cessation of profession or the retirement or death, the person carrying on of the profession, any sum received after the discontinuance shall be deemed to be the income of the recipient and charged to tax in the year of receipt. So at any time will include 176(3)(a) and 176(4), discontinuance of business or profession. Receipts after discontinuance of business 176(3)(a) or profession section 176(4). Are we clear? Then during the previous year, now here you have to be very careful to understand this now. So how about the prior period expenses? So before the business, not before the business, the expenses relating to prior periods. Because it says at any time during the previous year. So any prior period expenditure of the earlier year, whether that can be claimed during the current year. Can you claim the prior period expenses? The answer to that is yes or no. You have to tell me first. Can we claim prior period expenses? We cannot claim Tanuku. Okay? No, Karthik, we cannot claim the prior period expenses. So expenses only during the current year. So prior period expenses cannot be claimed. Prior period expenses cannot be claimed. How about the future expenses? Provisions. Provision for tax, provision for warranties, whether you can claim that. Can we claim the future expenses? No, we cannot claim the provisions as well, but there are certain exceptions to that. So, generally cannot be claimed. The exception to that is we can claim it if two conditions are fulfilled. And what are those two conditions? So the two conditions are that there is a reasonable certainty, there is a certainty, and they are capable of being ascertained. If the liability is certain, and capable of being ascertained. So, if there is a liability that is certain and if it is capable of being ascertained, then such liability shall be considered as liability in present time and not liability in futuro. So, any contingent liability, any future liabilities are not allowed as deduction. However, if you have any liability which is certain and which is capable of being ascertained, for example, provision for warranty charges. So the provision for the warranty charges is based on the past claims. So therefore, it is certain and capable of being ascertained. Then that can be allowed as deduction. Are we clear? Even ICDS 10. So look, here we have started making references to ICDS already. We are not going to, have a separate topic on ICDS. Okay, we are only dealing because that will not make any linkage. So you have to link it with the specific provision. That's how the ICDS has to be done. So ICDS 10 provisions. It provides that ICDS 10 provides that the provision will be recognized when a person has the present obligation as a result of past event. Present obligation as a result of past event. It is reasonably certain that an outflow of resources embodying economic benefits will be required to settle the obligation. It is reasonably certain that outflow of resources would be required to settle the obligation. And a reliable estimate can be made of the amount of obligation. Then the provisions can be recognized. Then the provision can be recognized. Are we clear? Also, there are other exceptions to the rule that the expenses of the previous year only be allowed. So if you see section 43B, it allows the expenditure on not on accrual but on payment basis when you make the payment. So even if the interest would have accrued last year, but if you paid during the current year, only then you would be allowed the expenditure. Similarly, if you have not deducted the taxes, you would not be allowed the expenditure. You would be allowed the expenditure only when the taxes have been deducted and paid to the government. So there are exceptions to this rule of the during the previous year. Are we clear? Any questions? Any doubt? Okay. So let's take a small break of 10-15 minutes. Let's take a break. Yeah. Okay, students, let's start. So now we have looked at general charge 28(1). Now we are moving towards the specific charge. All right. So now 28(1), as I said, was the general. And now we have certain specific charging section. What we are going to look at it now. So 28(2), I'll take you directly towards the section. Okay. So 28(2), any compensation or other payment due to or received by any person by whatever name called, managing the whole or substantially the whole of the affairs of an Indian company at or in connection with the termination of its management or the modification of the terms and conditions relating thereto. So any termination, compensation which is there for, let's say, a director who was managing the affairs of the Indian company, a whole-time director, right? If any compensation is given, then that particular will be specifically chargeable under the head PGBP. So see, ideally it could have been treated as a capital receipt because this is for the sterilization of the profit-making apparatus, right? A termination of the agreement. So therefore, it has been specifically put under the charging section. Are we clear? Then, any person by whatever name called managing the whole or substantially the whole of the affairs in India of any other company, meaning foreign companies' affairs in India, at or in connection with the termination of his office or the modification of the terms and conditions relating thereto. Okay. Third, any person by whatever name called holding an agency in India for any part of the activities relating to the business of any other person at or in connection with the termination of the agency or the modification of the terms and conditions relating thereto. So if any agency contract is terminated, that will also be chargeable. Any compensation for that will be chargeable under 28(2). Any person for or in connection with the vesting in the government or in any corporation owned or controlled by the government under any law for the time being in force of the management of any property or business. So this is in relation to the government company. Any contract which is terminated, that could be compensation chargeable under 28(2). Any person by whatever name called at or in connection with the termination or the modification of the terms and conditions of any contract relating to his business. So let's take an example. Let's say that I had been engaged in manufacturing and I had ordered for a plant and machinery, okay, from, say, a company. Now, this plant and machinery which I could not receive, there was delay in supply of the plant and machinery, for which I received the liquidated damages. We have done this example, right? So if the liquidated damages are received, whether that is a capital receipt or a revenue receipt, we have done that yesterday. What it would be very quickly. Saurashtra Cement Limited Supreme Court judgment. You're not revising very clearly. Please revise. Yes, Karthik, capital receipt. Why? It was held by Supreme Court in Saurashtra Cement Limited. Liquidated damages received by the company from the supplier of the plant for failure to supply. Damages inextricably linked to the capital asset which lead to the delay in coming into existence of profit-making apparatus. The compensation was for sterilization of profit earning source and therefore a capital receipt, right? Therefore, it was a capital receipt and not a business income. However, now if you see this 28(2)(e), it says any compensation or payment due to or received by any person by whatever name called at or in connection with the termination or the modifications of the terms and conditions of any contract relating to his business. So therefore, any liquidated damages paid for delay in supply of machinery would be then covered under 28(2)(e). So, this was held by the Supreme Court. However, you can write it here. Any compensation for termination or modification in terms PGBP under section 28(2)(e). So this has been specifically made chargeable. So as I told you, capital receipts are not chargeable unless specifically included. Are we clear? Any doubt? Okay. Let's move further. Okay. Third, income derived by a trade, professional or similar association from specific services performed for its members. So, if they are performing the general services for the members, let's say transfer fees, let's say entrance charges which are taken from the members and which are regarding for the services performed only for the members, all the members, then that is governed by the principle of mutuality. So, (28)(3). What does it say? 28(3). It says income derived by a trade or professional or similar association. Now, there is also a principle of mutuality, which means that one cannot make profit from one's own self. Are we clear? So, let's say I am charging certain entrance fee, or let's say some transfer fees or some charges which I'm collecting or which I'm collecting for the benefit of all the members of that particular association. So if it is for the general service charges, that is governed by principle of mutuality, which will not be taxable because one cannot make profit from one own self. But this is for specific services performed for the members. Let's say for example that I am collecting certain charges for a particular member. Let's say BSE is providing specific services to a particular stockbroker and it is charging a fee. Then that is going to be taxed under 28(3). That is going to be taxed under 28(3). Are we clear? There is also, I am making a reference over here to section 44A. Which is special provision for deduction in the case of trade, professional or similar association. Section 44A is the special provision for the trade, professional or similar association. So where any trade, professional or similar associations receive any amount from their members, whether by way of subscription, not being remuneration for any specific services, right? So this is the provision for the general services where any loss is suffered, where the expenditure incurred is higher than the amount received. So 44A is for the deduction of loss, which is expenditure minus receipts. Where the expenditure is higher than the amount received. This is for the general receipts or general services, as I may call, and not specific. Specific is covered under 28(3), right? So the amount of deficiency, how that deficiency will be allowed as deduction, that particular provision is dealt under 44A. Let me write it here. Deduction of deficiency instead of loss. Deficiency. So this deficiency will be allowed as deduction in computing the income of the association under the head PGBP. And the deficiency can also be allowed as deduction against the income under any other head if there is no income under the head PGBP. Are we clear? Are we clear? Any doubt about it? So what is the amount of deficiency which will be allowed? What is the deduction of the deficiency? So the amount of deficiency to be allowed as a deduction will not exceed half of total income of association total income of the association. Half of the total income of the association. Are we clear? So the amount of deficiency will be lower of the amount of deficiency or half of the total income of the association, whichever is lower. Are we clear? So that is how 44A provides for the deficiency. Any doubt with respect to this? Any doubt? Any questions? Any doubt? No, this is not relating to AOP or BOI. Aniket, I had explained in the last class also, sterilization means extinction of the profit-making apparatus. So the machinery was helping me to generate the profits, and if I have extinguished that particular machinery itself or ability to create the profit, then that is a capital receipt. But this can be specifically chargeable and because of the provision under 28(2)(e). Are we clear? Are we clear? Okay. So 44A allows the deduction of the deficiency where the amount received is lesser than the expenditure incurred by the trade associations. Are we clear? Deduction shall be restricted to not more than or 50% of the total income of the association. Are we clear? So, restricted to half of the total income of association. Clear? Let's move further then. 28, again moving towards that. 28(3)(a). 28(3)(a), which is with regard to profits on sale of a license granted under the Import Control Order 1955 made under the Import Export Control Act. 3B is cash assistance received or receivable by any person against the exports under any scheme of the Government of India. 3C is any duty of customs or excise repaid or repayable as a drawback to any person against exports. 3D is any profit on the transfer of the duty entitlement passbook. And 3E is any profit on the transfer of duty-free replenishment certificate. Then 4 is for the value of any benefit or perquisite, whether convertible into money or not, arising from the exercise of a business or profession. This is very, very important. 28(4). So it says value of any benefit or perquisite, whether convertible into money or not, arising from the business or the exercise of a profession. So let's take an example for this. Let's say whether cash benefit received, that will not be getting covered in 28(4), because 28(4) is for the value of any benefit or perquisite which is not convertible into, which is not money. Because it clearly talks about whether convertible into money or not. Here it is talking about the value of any benefit or perquisite in kind. So, cash benefit is not covered over here. Cash benefit is not going to be covered over here. However, here what will get covered is the benefit in kind, which is arising from the exercise of the business or the profession. Now, understand one thing. Here, there is new TDS provision which is introduced under section 194R. Which is introduced under section 194R, which is TDS on benefit or perquisite, which is what we are going to deal separately under the TDS chapter. But here, this has been recently introduced, and this is where the payer makes any payment of any benefit or perquisite which is arising from the business or profession will be liable for deduction of the TDS. Will be liable for deduction of the TDS. Are we clear? Any doubt? So, here, if any person is making the payment of any benefit or perquisite, then in that case, it will be considered as liable for deduction of TDS. Are we clear? Any doubt? Any questions so far? Also, in this respect, CBDT has provided the guidance on how do we deduct the TDS. Yes, Aniket, you're correct. Free samples and all will be covered over here. Free samples will be covered over here, as also there are many other controversies with regard to what will be covered under the TDS provision, because the TDS provision under 194R and the circular which is issued by the CBDT is clearly overriding this particular aspect. So CBDT has provided a circular on 194R, but the provision which is there under under the circular is in a way overriding the main section also. So that we are going to deal with it elaborately when we will be dealing under the TDS, specifically under 194R. Are we clear? Any doubt? So free samples are covered over here under 28(4). Any doubt? Any questions? Any doubt? Okay. So also understand one thing. Now here, what could be the examples of benefit in kind which is going to be covered over here? Let's talk about that. So let me tell you that what are the examples. As Aniket rightly pointed out, free samples are covered over here. It's not that the free samples are not covered. Of course, there are certain controversies which we will be looking into detail. Then here, reimbursements are also covered to some extent, which is again what we are going to deal with it elaborately. Also here, gifts could be covered. Expenditure on the conferences could be covered. Car gift, let's say, that could be covered. So there are various situations which could be covered over here. Right? So here, anything which is covered under kind, that is going to be covered as a part of 28.4. But as I said, we would be dealing with it elaborately when we are going to deal with the TDS section under 194R. Are we clear? Any doubt? How to pay TDS under 194R? Okay, let me explain it for the benefit of all. So, TDS under section 194R, how does it function? So, that will be functioning by way of the TDS paid by the payer, he making the specific arrangement for the gift in kind or whatever benefit in kind he has given. He has to make the specific arrangement for that before releasing the particular gift. So that is how the TDS obligations are to be covered. Are we clear? Any doubt? Any other question? Any other question? Okay. So there are several issues under 194R. As I said, we will be covering in detail when we are going to talk about 194R in detail, because those issues are majorly pertaining towards 194R. So I would restrict my scope over here rather than going into 194R, because that will take away all the time for the PGBP. Clear? Are we clear? Okay. Any other question? Okay, let's move further then. Then 28.5 is for any sum, whether received or receivable, any sum, whether received or receivable, in cash or in kind, under an agreement for not carrying out any activity in relation to any business or profession, or not sharing any know-how, patent, copyright, trademark, license, franchise, or any other business or commercial right of similar nature or information or technique likely to assist in the manufacturing or processing of goods or provision of for services. So any sum which is regarding the non-compete fee for not carrying out any business or profession, or for not sharing any know-how, that will be covered, because that could be a capital receipt, but that has been specifically brought to tax under 28.5A. So this covers business or profession both. So any non-compete fee which is received for the business or profession is not capital receipt, but it's a capital receipt, but specifically chargeable under 28.5A. Are we clear? Then this will not apply to any sum, whether received or receivable in cash or kind, on account of transfer of the right to manufacture, produce or process any article or thing, or right to carry on any business or profession which is chargeable under the head capital gain. So any right which is kind of an asset which is transferred will not be covered here, will be taxable under capital gain. Here, any compensation which is received or which is non-compete fee which is received, that is going to be covered over here. Are we clear? Similarly, any sum received as a compensation from the multilateral fund of the Montreal Protocol on substances that deplete the ozone layer under the United Nations Environment Program, that will also be not covered here. Are we clear? Then 28.6 is for the any sum received under a KEMAT insurance policy, including the sum allocated by way of bonus on such policy. So here it could be KEMAT insurance policy for the directors, because if it is for the employees, that is covered under section 17. So that will be covered under the head salary, but this if it is for the professional or for the directors who are not the full-time employees, then it will be covered under the head PGBP. And if it is for any other person, then it is covered under income from other sources under section 56. Are we clear? Then 28.6A, the fair market value of the inventory as on the date on which it is converted into or treated as a capital asset determined in the prescribed manner. So what is 28(6)(a)? If you remember, we have 45(2) for the capital asset converted into stock in trade. So now, earlier we did not have any provision for stock in trade converted into capital asset. So now, if the stock in trade is converted into capital asset, the fair market value of the inventory will be taxable under the head under the head PGBP. So, I'm so sorry. I think it stopped. Okay. So, if I give you the note of this, just write down 28(6)(a), fair market value of inventory as on the date of conversion into capital asset. Are we clear? How we have to determine the fair market value? So the fair market value, as you saw, it says 28(6)(a) says in the prescribed manner. Prescribed manner means you have to go to the income tax rules. So rule 11 UAB of the income tax rules deal with the valuation of the fair market value for inventory under 28(6)(a). It says, in case of immovable property, which is held as inventory, stamp duty valuation. So, FMV of the immovable property shall be the stamp duty valuation for the purpose of payment of stamp duty. In case of jewelry and any other property, so it will be value, it will fetch in open market as on the valuation date, and if purchased from a registered dealer, then invoice value. Then the invoice value. So rule 11 UAB is dealing with the valuation of the fair market value when the inventory is converted into stock in trade. Are we clear? So what will happen when the inventory is converted into stock in trade? This is the taxability under the head PGBP. Okay, so first, taxability under the head PGBP. This is as on the date of conversion. So on the date of conversion, FMV or PGBP, it will be equal to FMV as per rule 11 UAB minus cost, right? The second effect will be under the head capital gains, which will be equal to selling price, which will be the actual selling price minus cost. Now, what will be the cost over here? So here, what will be the cost? What will be the cost over here? So here the cost will be this FMV. The cost will be this FMV. As per 28(6)(a). And where it is provided? Section 49(8) of the, this is as per section 49(8) under the head capital gains. Are we clear? So cost will be the FMV which is taxed under the head PGB. What will be the period of holding? What will be the period of holding? So in the case of where the inventory is converted into a capital asset, the period will be reckoned from the date of conversion. So period of holding will be from date of conversion. Are we clear? This is as per explanation 1 to section 242A. Are we clear? Period shall be reckoned from the date of its conversion or treatment. Any doubt? Okay, let me give you an example here. Let's say I have the inventory which is converted into stock in trade, let's say on 1st September 2022 and sold on, let's say, 1st March 2023. Purchased on 1st September 2021. So in that case, the PGBP will arise in the year of conversion, which is in the previous year 22-23. I will take the FMV as on 1st September 22, right? My period of holding year will be from September to March. So therefore, this will be short-term capital gain. Are we clear? Are we clear? Any doubt? Okay. Perfect. Next one, last 28 section, which is 28(7), which is any sum whether received or receivable in cash or kind on account of any capital asset other than land or goodwill or financial instrument being demolished, destroyed, discarded or transferred if the whole of the expenditure has been allowed as deduction under 35AD. So if any asset which is allowed a reduction under 35AD is demolished, destroyed, discarded or transferred, then any sum which is received, then that will be taxable under 28(7). So ideally it should have been under capital gain, but this has been specifically chargeable under the head PGBP by way of 28(7). Again, we will be dealing with it in detail when we will be touching upon 35 AD. Are we clear? Then explanation 2, if you see, talks about the speculative transactions carried on by the assessee, which will constitute the distinct and separate from any other business. That also we will be touching up later on. Are we clear? Coming to section 29 for the reference, which talks about the income from profit and gains, how is to be computed. So it says that the income referred to in section 28 shall be computed in accordance with the provisions contained in section 30 to 43 AD or 43D. So how is it to be computed? Let's see. So 29. How do you compute 29? Under 29? Section 29. Computation of income under PGBP. So you start with first net profit as per your profit and loss account, which is your book profit. Are we clear? You add or less amount chargeable, or sorry, you less under other heads. Then you will add amount inadmissible as expense, and then you less amount allowable as expense and not debited to P&L. First is amount inadmissible as expense and debited to P&L. Second is amount allowable as expense and not debited to P&L, that you will reduce. Then add or less treatment as per ICDS. This will give you income chargeable under the head PGBP. Are we clear? So this is how your computation will function. Clear? Okay. Then let's move towards section 30, 31 and 32. 32 will move later, but 30. So section 30 is for the rent, repairs relating to the building. So section 30 is for rent, repairs, taxes, insurance, rates for building. Are we clear? Then it says that in respect of rent, repairs, taxes, insurance used for the purpose of business or profession, for premises used for the purpose of business or profession, the deductions will be allowed for the rent, rates, taxes, repairs, and insurance. So amount of premium paid in respect of insurance against risk of damage or destruction, amount of municipal taxes which are paid where the rent premises are occupied by the assessee as a tenant, then the rent paid, the cost of repairs to the premises. So whatever repairs are done to the premises, all of that will be allowed, except which is not a capital expenditure. So current repairs will be allowed and not capital expenditure. No capital expenditure. Similarly, section 31 is dealing with the furniture, machinery and plant. So 31 deals with repairs and insurance of plant and machinery and furniture. So amount of current repairs and amount of any premium, insurance premium paid will be allowed. Again, this will not include any capital expenditure. Are we clear? This will not include any capital expenditure. Clear? Now again, here I would like you to refer certain judgments over here. So here we are going to refer to certain judgments. Are we clear? Now this is again in the context of capital versus revenue expenditure. Right? Capital versus revenue expenditure. I am going to refer certain judgments for you. Now, we had done the capital versus revenue income, if you remember, in the last class, the very first lecture. So, understand one thing now. Whether the expenditure is capital or revenue in nature, that is determined based on the facts and based on the judicial decision. So various tests have involved for distinguishing between capital and revenue expenditure. But there is no conclusive answer to that, or there is no ready formula for that, whether an expenditure is capital or revenue. So every case has to be decided based on its own facts and the circumstances of each and every case. So, but the courts have laid down several judicial principles. And what are that? That when an expenditure is made with a view to bringing into existence an asset or an advantage for the enduring benefit, then that expenditure will be a capital and not revenue expenditure. So, expenditure to bring in asset or an advantage of enduring nature, this will be considered as capex. So here I am again making reference to ICDS 5, which is for the tangible assets. It provides for capitalization of an expenditure It provides for the capitalization of expenditure that increases the future benefits from asset beyond its previously assessed standard of performance. Are we clear? So it provides for capitalization of expenditure that increases the future benefits from the existing asset. That expenditure has to be capitalized. Also, it provides that an addition or extension to an existing tangible fixed asset, which becomes an integral part of the asset itself, is to be added to the actual cost of the asset. Clear? Now, let's discuss several principles which have, as I said, been derived. So not every advantage of the enduring nature is a capital in nature. So what is material to consider is the nature of the advantage, and whether that advantage is in the capital field, that it will be a capital expenditure, or that advantage is for facilitating the assessee's operations or enabling the management and conduct of the assessee's business to be carried on more efficiently or more profitably. So, what did I say you first? That the expenditure which is for the asset or for the enduring benefit, that will be a capital expenditure. But mind you, every advantage will not be in the capital field. Some advantages may not be for a longer period, but for facilitating the assessee's operations or enabling the effective business or carrying out the business effectively or profitably without touching the fixed capital. Though the expenditure will be on revenue account and not on the capital account, even though the advantage may be for an indefinite future. So let's take an example that, let's say for example, that the assessee had, let's say, purchased certain, assessee was into the loom. You know the textile looms, right? So there the assessee purchased the loom hours so that it could remove the restrictions which are there on the working hours for operating the loom. Now that expenditure is for the benefit of carrying out the assessee's business effectively. And therefore it will not be a capital expenditure. Let's take another example, that where, say for example, the assessee incurred the expenditure for construction of transmission lines so that it could supply the power to the government. So in that case also, if you see, the courts have held that the expenditure is incurred for the laying of the transmission lines, and which was done to supply the power to the government at lower cost, which aids the assessee to efficiently conduct its business. So therefore, this was not an advantage of capital nature, and therefore this was revenue expenditure. Are we clear? So where the expenditure which is done is for the efficient conduct of the business. So, expenditure for efficient conduct of business, even though of enduring this will be a revenue expense. Are we clear? Are we clear? Any doubt? Any questions? Any doubt? Any doubt? Okay. So if the expenditure is for the benefit of the business, then it is a revenue expenditure even though it is enduring. Are we clear? Let's say, for example, if the assessee has discontinued operations of one business. So let's say assessee has paid the compensation to the employees, retrenchment compensation, because it closed down one unit, let's say textile unit. Or let's say one manufacturing segment, let's say manufacturing segment of soft drink. So in that case, it has suspended one of the business activity, but the remaining business has still continued. So then in that case, that expenditure would not be of the capital in nature. That will be treated as revenue expenditure because the remaining business is still functioning. So that will be, if the entire business is closed, then it could be a capital expenditure. But if one business is closed, then that will be considered as the revenue expenditure. Are we clear? There was another very important decision in the context of IBM Global. There, the assessee company paid certain amount for the acquiring the customer database and transfer of the trained personnel from its another joint venture company. So the question was whether the acquisition of the customer database and the trained personnel was a capital expenditure. So the court in that case observed that the expenditure which was incurred for the use of the customer database was not any capital asset. The assessee got the right to use the database, and the company which provided the database was also using it. It was not that it has acquired an asset altogether and the other company is precluded from using that. So as regards the customer database, that was held to be the revenue expenditure. Similarly, the employees which were being acquired, they were trained employees. So these employees, they were acquired from the joint venture company. Now these employees were again assisting the assessee's business to be carried out efficiently, and therefore this was not a capital expenditure. Are we clear? This was held not to be a capital expenditure. Another decision in the context of where the assessee had incurred certain expenditure on the feasibility study to be conducted for examining the proposals for certain technological advancement to be carried out in the existing business. So the assessee had done certain feasibility study for the purpose of bringing in some new technological advancement in the existing business. The expenditure was held to be of revenue nature. Why? Because no new asset has come into existence. So if there is no new creation of any asset, then the expenditure incurred would be of revenue nature. The feasibility studies were conducted by the assessee for the existing business, wherein there was common administration, common fund. There was no new asset which was coming into existence. Therefore, the expenditure was held to be revenue in nature. Any doubt till now? Okay. Similarly, there was another decision where if you are doing any expenditure for the feasibility study, for conducting the test study, for pilot studies, for improving the business, that could not be held to be a capital expenditure. That cannot be held to be a capital expenditure because this is for the improvement of the performance of the existing business and no new asset is coming into existence. Are we clear? Are we clear? Any doubt? So where no new asset is coming into existence and there is existing business for which the improvement expenditure is being carried out for conducting the feasibility study, therefore that expenditure will be revenue expenditure. Are we clear? So even under section 31 and 30, only current repairs are covered over there, which do not include any expenditure for bringing in a new asset into existence or to obtain a new advantage. If, let's say, for example, if the entire machinery is replaced, if the repair is of such nature that the entire machinery is replaced, then that will not be the current repairs. So if, let's say, the machinery has become old and the repairs are of such a substantial nature that entirely new structure is coming into existence, then in that case, that will not qualify as the current repairs and that will not be allowed as deduction under section 31. So where the entire, let's say the machinery or let's say the computer's configuration is changed, where the structural alterations are done to the building, that is to be considered as capital repair and that will not be allowed as deduction. But let's say, for example, I have a computer and I'm just upgrading it by installing new softwares, which is just improving the efficiency of the computers. That will be current repairs. That will be current repairs, right? So where, let's say, the machinery itself has outlived its utility and huge expenditure is incurred by replacing the vital parts to make it functional, then a new asset is coming into existence altogether. because there will be a benefit of enduring nature. But where it is just a normal efficiency repair, just the efficiency is being increased, there is no change in the performance, there is no new advantage, then it will be the current repairs. Are we clear? Any doubt? Any questions? So, in case, as I said, what is the distinction between current repairs and the capital? If it brings the advantage of enduring nature, it will be capital. If it brings a new asset, it will be capital. If it just improvises the performance, if it assists in the assessee's business to be carried out more effectively, then it is a revenue nature. Are we clear? Now, moving on to section 32. We'll just start with it. Maybe we'll dwell with it into tomorrow in more detail, but we'll just start with it. Which is your favorite section, depreciation. So, let's talk about depreciation. We'll divide it into three parts. Conditions for claiming depreciation. Basis of depreciation. And computation of depreciation. First, we'll talk about the conditions for claiming the depreciation. The first. I'm sorry. Okay. What are the conditions for claiming depreciation? So section 32(1) says assets owned wholly or partly by the assessee and used for the purposes of the business or profession. So the first condition is owned by the assessee. It should be an asset owned by the assessee. Now, what do we understand by the owned? What do we understand by the owned by the assessee? Whether it should be legally owned or even when one is not the owner, it could still be claimed as a depreciation. So that's what we are going to learn now. So owned means that it should be the assessee should be the owner of the particular asset. Invested in that particular asset. The assessee should have invested into a particular asset. Are we clear? So owned by the assessee means that it should have been invested by the funds should have been invested by the assessee. Owned wholly or partly by the assessee. That's the first condition. So even a beneficial owner is entitled to depreciation. Asset owned by the assessee means the person who has acquired the possession over the building and uses the same for the business and profession, even though he is not the legal owner. Even though he may not be a legal owner. So even though, let's say, for example, the registration has not been done in my favor as yet, even though I'm not a registered owner of the immovable property, or let's say of the, for that matter, vehicle, I can still claim the depreciation because if it legitimately belongs to me, I have invested in the capital asset. Let's say hire purchase agreement, where the agreement is done on hire purchase, where initially I'm paying the rentals, but at the end of the period of hire purchase, I'll be entitled to purchase the asset. Then in that case, in the case of hire purchased agreement, who is entitled to claim the depreciation? Whether I am entitled as a hire purchase or the owner who has given it to me. So in that context, in that particular context, there is a CBDT circular in that regard. There is a CBDT circular in that regard which talks about the hire purchase. So it says that no depreciation will be allowed to an assessee in respect of which he does not own but only hires for the purposes of his business. So if I am a lessee, I will not be entitled to depreciation. I'll be only entitled to rent, which is under 31. Because that is not owned by me. Are you getting that? So if I have assets on hire, then I will not be entitled. However, in case of hire purchase, which is different from normal hire agreement or lease agreement, there is a CBDT circular number 9 of 1943 which provides that where the effect of an agreement is that the ownership of the asset is transferred on the lessee. The transaction should be regarded as one of the purchase by installments and not that of rent. So rental amount will not be allowed as deduction. You will not get double benefit of allowing the rentals as well as the depreciation. Either you can get rental or you can get depreciation. So where if you have entered into a hire purchase agreement where it is the effect is that the ownership is transferred, then in that case the depreciation will be allowed to the lessee on the hire purchase price. So where the terms of the agreement provided that the asset will eventually become the property of the lessee, then in that case the lessee will be allowed the depreciation. So where the assessee has the option or the lessee has the option to purchase the asset, or the asset will eventually become the property of the hirer, the transaction would be of the hire purchase. Then the amount will be regarded as the amount towards the purchase price and the depreciation will be allowed on that. Are we clear? Are we clear? So in that case, we have the CBDT circular, depreciation to lessee if asset will eventually transfer. If the asset will eventually transfer. Are we clear? Any doubt? Where, however, it is not the case, where it is not a case of hire purchase, then in that case, the lessee will not be allowed. So, lessee not allowed depreciation, but in hire purchase, it will be allowed. Are we clear? Any doubt? There is also one more exception to this, which is explanation 1 to section 32. Explanation 1 to section 32. So in respect of assets leased out, it is the lessor who is the owner, though the asset is used by the lessee. Since lessor is the owner. Are we clear? Are we clear? However, as I said, explanation 1 to section 32(1) provides that where the business or profession of the assessee is carried on a building which is not owned by him, building not owned by lessee, but he holds a lease and he has incurred capital expenditure on the construction of any structure. Capital expenditure on construction of any structure in relation to renovation or extension of building. Then lessee entitled to depreciation. So this is one such exception to section 32(1). If lessee is eligible to claim depreciation where the business is carried on from the building not owned by the lessee, but he has incurred substantial capital expenditure on construction of a structure in relation to the renovation or extension of the building. Then it will be deemed to be that the structure or the work is building owned by the assessee. So if an assessee has taken a premises on lease and made a capital investment to improve the same, he can claim the depreciation. Are we clear? Any doubt? So first condition was owned by the assessee. The second condition is, so in this case, okay, let me just write down. Lessee entitled to depreciation as if structure or work owned by him. Are we clear? B condition. Asset used for the business or profession of assessee. So the first condition was owned by the assessee, and second is for the business or profession. Are we clear? Any doubt? So asset used for the business or profession of the assessee. So it must be used for the business or profession of the assessee. What do we mean by that? What do we mean by that? That it could be even on the ready to use asset. It should not be that only it is put to use. Of course, the depreciation will be available to you when it is put to use. But even when, say for example, we have kept the generators, which are ready for use, but will be used only when required. So even passive use is good enough for the satisfaction of the user test. So although it should be put to use, but even ready for use will be allowed. Are we clear? Any doubt? Karthik, example for which? Aniket, I didn't get your doubt on addition cost incurred or whole cost. Okay, you are Aniket asking for the building. Yes, it will be on the addition cost, as that the structure is owned by the assessor. Karthik, example for what? Okay. Hire purchase and lease transaction. Karthik, I provided the example. Let's say I have taken the building on rent, or let's say I have taken the car on rent. Okay. I've taken car on rent. I'm paying the rentals. I'll be only allowed rental deduction. The depreciation will be allowed to the owner of the car. But let's say I have entered into an agreement that I will be paying the installments as a form of rental, but at the end of the rental period, I will have an option to purchase the asset. That will be a hire purchase agreement. In the hire purchase, I will be considered as the owner, because when I will be given the option to purchase, my earlier installments will be adjusted. So then in that case, the lessee will be entitled to depreciation. Clear, Karthik? Okay. So thank you so much, students. Next class, we would be again talking about depreciation and other allowances. So good night and see you day after tomorrow.